This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Investor Connect is a 501c3 nonprofit dedicated to the education of investors and startups for fundraising. Please consider donating $100 to the program to help others in their investor and entrepreneur journey. You can find the donate button on the investorconnect.org website. Hello, this is Hall Martin with Investor Connect. Today we're here with Stefano Gurciullo, partner at Redstone VC. Redstone VC is a Berlin-based venture capital firm managing multiple sector-focused venture capital funds and working with corporate venture funds. They feature a strong corporate base behind their funds with the ultimate goal of democratizing access to private capital for a more diverse variety of investors. Stefano, thank you for joining us.
Thank you. Thank you, Martin.
Great. So tell us more about your background before investing in early stage companies.
Yeah, with pleasure. I'm actually a bit of an outlier when it comes to venture capital because of my trajectory. I come from academia. I did a PhD at University College London where I focused on a funny discipline called complexity science, which is a very complicated name for a set of tools coming from physics, ecology, biology to study how things interact with each other. Whether these things are animals, whether these things are verbs. So you can already see how this actually fits in terms of mindset venture investing. We call it innovation ecosystem for a reason, because you have investors, companies that interact with each other. And I definitely took this philosophy into the way I do investing. After my PhD, I worked a lot across data science, finance, and sustainability by doing some of the very first quant investment strategies in sustainability, especially in the public markets. And after that, I just ended up on the dark side, really applying what I learned along the way, academia as an investor and entrepreneur in modern markets, into venture capital. That's how it came about.
Great. So what excites you right now?
Yeah, so we at Preston have a very diverse set of funds. And each of them is sector focused. Where I'm spending most of my time is in our fund called Future Industry Ventures, that is focusing on European tech that is making manufacturing system more sustainable, more secure, and more decentralized. So what excites me right now is really deep technology. So technology that is really hard to make, really hard to replicate, with some IP or essentially some really strong engineering and scientific feats to be performed that really can change the way we do manufacturing. And this is where I invest.
Great. Well, there's a lot of work you do with startups and investors out there. What's your advice for people investing in startups? What do you tell them to do before they write that check?
Yeah, we always exchange feedback with other peers and investors along the way. Things that I learned and that I try myself to apply, especially in the fields that I've been mentioning. So, deep technology for manufacturing is to make sure that you as an investor offer beyond the ticket, beyond your money, sort of a platform that may help them, that can help those potential portfolio companies into growing. B2B sales in deep technology is very hard, especially at the beginning. Finding the right talent, especially at the beginning, is again very hard. And what I'm finding is that many of us investors, I wouldn't say failing, but we need to get better in providing a set of added value behind, such that we can not just get the best deals. Obviously, at the end of the day, it's also about that, but also becoming a better value add to those founders that are really spending time doing some of the hardest thing.
Great. Then on the other side of that table, what's your advice for people running startups? What do you tell them to do before they go out to raise funding?
Yeah, so many things. But if I had to flip the coin, I always appreciate a founder that does their due diligence on the investors they talk to. It's not always easy. Founders talk to potentially hundreds of investors at any single point in time where they need to fundraise. But I think it's really important to show that you know what the investor is focusing on, given the information you might have available, and also do some due diligence. Ask portfolio companies how we behave with them, about our track record, about potentially our LP base. I think we're lacking on our side, not consciously, some transparency towards founders And now that the market is getting more and more competitive on our side, I think it's only fair for founders to be more proactive and be more pushy to ask for feedback, information, and background of us investors.
Great. Well, let's talk about the state of startup investing. How do you see the industry evolving from here?
I think right now we are experiencing lots of very, very interesting changes. Some of them will remain, some of them will not. I just mentioned two of them. One is what I'm noticing is what I call a boom in diversity. What I mean by diversity, sadly, not diversity in say gender. I think we get in there, but not quite. What I mean is the rise of a wide variety, especially in Europe, of new fund managers that are incentivized by local political pushes and incentivizations coming from national governments about investing in their own markets, new technologies that require specialized knowledge, such as climate change, right? You have new funds just doing that, just focusing on climate and decarbonization. We see a lot of that coming, which private capital that is coming in, flowing into these new fund managers. Will this last? I'm not sure. Obviously, what we learned in the past probably 20, 30 years is that you have these waves of 1 year surplus of private capital of new fund managers that then fade away as soon as they don't manage to build the right portfolio. So that's one thing. I think we're really up the wave of this new diversity in funds. The second thing that I'm noticing, and here probably not many will agree with me yet, but in 5 years I'm sure they will, is the rise of Southern Europe. Already now, Europe, with hubs such as Berlin, such as London, Paris, is booming. We know with the latest State of European Tech report by Atomic, one of the major European VC firms, right? Southern Europe is still in the shadows. We already started investing there, countries such as Italy, Spain. There is amazing talent out there, amazing entrepreneurial talent, amazing science. So especially for those people interested in deep tech, what's lacking is really the processes to bring these things up, right? And that process is also include investors. So that's really one big wave that is starting now already, in my opinion, that we will see quite evident in the next 5 years.
And what do you think is the biggest change we'll see in, say, the next 1 to 2 years?
The biggest change in the next 1 to 2 years is a change with regards to the scope of funds. What I'm noticing right now is that things like ESG, environmental, social, and governance, and this focus on climate is a special thing right now. Fund managers only focused on that. It's becoming a great value proposition. I think that in 2 years, it will become, I wouldn't say the norm, but every single fund will have to have some sort of ESG strategy to push on. And this strategy will have to be applied also for every single portfolio company that they want to have. And this comes in two ways. One is the LPs are pushing. More and more LPs I see are getting more interested in ESG matters. And two is regulation. In Europe right now, we have new regulation that incentivizes or rather wants us, fund managers, to classify ourselves with respect to various ESG dimensions. This is something that is happening very, very fast. There's going to be some changes in European regulation happening already this year, and that will become the norm in the next 2 years.
Great. Well, let's talk about your investment thesis for your fund. What exactly is it, and what's your criteria for making an investment?
Yeah, as I said before, we focus on companies that are using deep technology to make manufacturing more sustainable, more energy efficient, more secure, and more decentralized. That's a big thesis. How do we translate that? I can give you an example. The way we think is through risks, right? We notice and we try to quantify what kind of risks are likely to disrupt, in a negative sense, the manufacturing chains, manufacturing value chains, and so on and so forth. And then based on that, we create investment theses. Just to mention a few, maybe two actually, that are very, very exciting for us right now. One is, not surprisingly, all the concept of securing the value chain. Cybersecurity has always been on top of everybody's mind, but I am surprised how we still are so far behind, especially in industrial applications when it comes to solutions on cybersecurity. We still are not, your laptop is more secure than a set of industrial assets in a manufacturing plant. This is amazing. So we're really seeing that happening together with an increase of cybersecurity attacks coming from some various groups around the world. This is something that we heavily invest in. And we have a company already in our portfolio called Exane out of Rome, Italy, that's, for example, addressing this. So this is one. The second investment thesis that we are currently working on is the future of the semiconductor world. That comes in two ways. In the past year or so, we saw disruptions in the supply chain for chips, right? Because of COVID, because it was hard to get things, say, from China. And this is affecting not just the big players, but even more so our portfolio companies. Our hardware companies had some delays of months or even more sometimes in creating, in assembling their product. So the question comes, how can I go and mitigate supply chain risks? And at the same time, how can I use new types of semiconductors that are more powerful, computationally speaking, but at the same time more energy efficient, because we cannot just expend the same amount of energy we do right now for data centers. It's too much. So our thesis now is focusing a lot on what kind of new product or new solutions do we need in order to make computing more energy efficient, less dependent on supply chains on the kind we are now. And again, in Europe, we have a massive amount of very interesting players working on it. Just to mention a couple of companies, this is just out of generosity. This is not our portfolio, or rather not yet, I hope. One is Ingaterra, which is a Belgian company, spin-off from a university that is addressing these sort of issues. There is another one in the UK called Intrinsic, also addressing these issues in another matter. These markets are huge. They are still not getting enough investor interest, and this is what we want to contribute to.
Great. So you see a lot of challenges out there. What's the main challenge your startups face when they're launching their business?
Our companies tend to be not the standard B2B SaaS, B2B SaaS, sorry, at least not all of them, right? Because again, there is this really strong engineering scientific challenge. When you provide something so new, you have a major risk in terms of go-to-market. This is really our major risk, right? How can I make sure that I sell to my potential customers as fast as possible so that I can generate the revenue that I, as an investor, expect? This is the main challenge that our companies have. And that's where, again, I go back to my, let's say, advice to the investors of us working with our founders as a platform. When I invest in a founder, and I'm very well aware of this sort of go-to-market risks, I try my best with the LP base that we have, with our own tools to help them in this journey by helping them becoming more and more closely integrated with corporate customers, by hiring and setting up the right team and setting up the right processes for this sort of sales. That is not easy. It is not easy at all. It is not B2C. It is not simply B2B SaaS. It's more complicated at the beginning. Well, once you go past that step, then you grow, and then you grow very fast.
And then on the other side of that table, what's the challenge investors face in today's market?
I would say that probably this is something recurring in this podcast. It's becoming, even for top tier or whatever you want to call VC funds, harder to get into the certain deals. I think that is a good thing. Why? Because we investors tend to have, among all the, let's say, the sectors in finance, in VC, quite a herd mentality, right? Everybody gets excited about the same thing at the same time, and everybody wants to invest in the same founders, which I find it funny, but that's how the world is, right? So now that we have lots of investors that are looking all at the same founders, this is pushing our community to really say, okay, maybe I can think in another way and find those assets, those founders that are maybe undervalued by others. This is the main challenge. That at first you say, oh, wow, I cannot get to this deal even though I'm that good. Maybe I should not follow the herd and coming up with other targets. And I think this works well. Some of our best investments have been really detaching ourselves from what everybody else was doing and finding the amazing people, amazing teams that nobody else was, or rather less people were looking at.
Great. We see a lot of different sectors and applications out there. If you had to pick one or two that are good opportunities for investors to pursue today, what would you put at the top of the list?
I think I already mentioned two that are really, really interesting for us. Maybe another one that we are really going deeper is the entire concept of decarbonizing the resources that you need in a built world. What do I mean by that? We build things. Humans are very good at building things. We mainly use concrete. We use metals. This stuff creates an enormous amount of CO2, an enormous amount of emissions that is, partly the reason of why we're experiencing climate change right now. That is, if you ask me, a massive investment opportunity for two reasons. One, we are looking at technologies that are ready now. 10 years ago, that was not the case. 5 years ago, that was not the case. Now, out of countries such as Switzerland, Germany, the UK, you have amazing science coming out of university, being commercialized by former PhDs or just very capable entrepreneurs. The technology risk is being mitigated. Two, the market, the buyers are out there. I'll give you an example for concrete. Concrete, the problem has been so far that, to have less carbon intensive concrete, it's like buying a bio product on the supermarket. It costs you a bit more. If I want the fancy apple that has no insecticide on. And there obviously someone that uses concrete doesn't want to spend their money. This is changing now. We see technology that is just as cheap, if not even cheaper sometimes than current incumbents products in concrete, for example, and now you have an investment opportunity. That is one thesis that I actually spend a lot of my time on, and I wouldn't find other investors to also spend the time on.
Well, in the last few minutes that we have here, what else should we cover that we haven't?
Yeah, a very interesting question that makes me stay awake at night sometimes is the following. For the last 15 to 20 years, venture capital has been really geared towards the successful story of pure software. The software that in 3 years gives you orders of magnitude more of a return on investment. And this is amazing. And this is still happening. At the same time, as you probably noticed during my chats, I'm extremely excited about deep tech, which takes longer to go up, to have that exponential return that we want. And it seems to me that venture capital as an asset class has to maybe rethink partially itself in order to accommodate the sort of assets. So perhaps one question that I also invite other peers in my community is really, what kind of models of investing, what kind of doing investment, what kind of funds can we create, do we need in order to accommodate this very interesting new assets out there that is the tech that is still not enough well served, in my opinion.
Great. So how best for listeners to get back in touch with you?
Probably the best way, everybody says Twitter. I don't use Twitter that much. I'm really sorry for that. So probably the best way would be through LinkedIn. And I guess you can find my profile on the webpage.
Great. We'll include that in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thank you. Thank you so much. Have a great day.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.